Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about existing home sales, home prices, and purchase apps heading into the spring housing market. Logan, welcome back to the podcast.
Oh, it is nice doing this 3 times a week.
It
We
is
just
nice.
got to get the other 2 days in, and then the brain candy's a 5-day-a-week thing.
Listen, there's other news happening, although this economic news is really important. Okay, well, let's talk about existing home sales and especially home prices. Let's talk about both of those things.
Yes, 2024 forecast is going to be wrong. I forecasted a little bit too low. I was looking for 2.33% home price growth. And what we see now in the data is that starting in summer, our forward-looking tracker data started to get better. Because everybody's enamored with the purchase application data and keep on saying sales are at record lows, the supply and demand equilibrium they're not trained to read that. So that was actually a big deal that the forward-looking data got better. But what it did was the effective seasonality weakness that we would see in the second half of 2024 was somewhat negated because rates went lower, purchase application data improved, pending contracts started to prove in August. Then what happened is in October, it noticeably started to get better versus 2022 and 2023 data. So in that context, we ended the year off on a high note. Sales fell a little bit from 2023 levels, but now that we're here, you can see why I've always stressed that 4 million level. Post 1996, we rarely have like monthly sales going below that, but now we have had the back-to-back, lowest home sales ever if you want to adjust it to the workforce. We still haven't broken under 4 million, but this conversation goes all the way back to November 9th. Everything changed in housing November 9th. It was such a historic crash in sales. Home prices were authentically falling.
And this is 2023, right?
Yeah, this is
November 9th, 2023.
In the second half of 2022. So those things, but we made a theory that if home sales just hold their ground at 4 million, and if the forward data gets better, then you're going to have to go with it. And that changed the whole supply and demand equilibrium in 2023 and in 2024, because if you didn't know home sales crashed and we were just hovering around here at 4 million for 20 years, would you change your mindset about housing? Yeah, you would. Naturally, because everyone think, well, home sales crash, prices have to fall. And this goes back to the original discussion in 2022. There are a lot of fake housing experts who say prices follow volume. So here it is, 2022. Y'all know who I'm talking about too. So don't be shy. 2022 home sale. There you go. You got your fastest crash ever. 2023, the lowest home sales ever. 2024, the lowest. Is the home price crash in the room with us? Hello? Are you here?
Is it in the room with us now?
Yeah. Is it? No. And it's gotten to the point that a lot of doomers have basically kind of, are giving reasonable forecasts now because it didn't work. And I always harpen back to our November 9th thing. The dynamics shifted there. You just have to have the ability to read forward-looking data. And we've made this argument that people don't have this, right? Or they don't know how to read it right. It was the hilarious part was like watching people like ruin Redfin's data and like take their charts and like say that prices are just like, in any case, in 2025, here we are. And that whole premise from 2022, 3 and 4 didn't work. But why? Supply and demand equilibrium. The history of housing economics post-World War II, it's not rates that drive prices down. It's that supply that in terms of crashes was 2007-11. Major supply increases, then distressed sellers. Right? In 2007, the NAR's inventory data peaked at 4 million. It started to go lower in 2008. So, see, not a lot of people know this, but active inventory was actually falling in 2008 in that time. The monthly supply actually were elevated in 2008 and 9 and 10 in big terms. But then we had distressed sellers into the mix. So the supply and demand equilibrium were so different. Here today, we're just a tad above 1 million. By the way, another round of applause to the Silver Tsunami crowd because it's 2025. And this grifting crew actually started in 2008, said that from 2015 to 2025 would be the unbelievable time that all the baby boomers were all going to downsize to the millennials who could not buy avocado toast, but they couldn't buy homes. They had to cut their prices, and active inventory would be between 26 to 32 million. We end 2024 with just a tad above 1 million today. 3.3 months of supply, a tad above 1.1, I think 1.15 million active inventory NAR data.
And there are very few Q&As that I've seen you do where someone doesn't bring up something about the silver tsunami. And they're not doing it to like, I mean, they're interested. They're like, hey, isn't this going to affect things?
I have been dealing with the silver tsunami since the Peloponnesian War, Sarah. It is just going to be with me until the afterlife. And it was a very, very effective grift because it would make sense to the eye, right? The first baby boomer hit 62 in 2008. There's so many of them out there. They all have to downsize. And from 2015 to 2025, the massive supply increase, something we've never seen, not even in the housing bubble crash years, 26 to 32 million. And it was a tragic failure. And all of these people will be going to the graves with this one because it did not happen. And we're in 2025 now. So I'm pretty sure I'm going to be dealing with this for the rest of the century. So it's fun for me.
I know you do love answering that. When someone asks you that in a Q&A, I'm like, oh, here it goes.
Oh, yeah. Just a big old grin comes in my face. I go, wait a second. This is my favorite subject. So I just hope people could understand that one of the things we try to focus on is most sellers are buyers. Okay. And why don't we listen to middle-aged men podcast stock traders, Sarah?
I mean, I can think of several reasons.
Yeah,
what would you say?
Because they look at everything as an asset. We have people actually try to do 200-day moving averages with inventory data. I was like, what are you doing? Right? No, it doesn't, because you can literally get margins sold out of your position at 12 o'clock. You don't have that kind of velocity in housing, right? A foreclosure process takes minimum 9 to 18 months. You can get margined out in 9 to 18 seconds. So the whole notion, it's funny because we actually tagged the stock trader guy on Twitter today who said, oh, new listings, 7% mortgage rates. Everyone's going to rush to sell. Stock traders, think of a different line. Rush to sell to get out of their homes. No, it has not happened for 14 years. And here it is. The irony is that, the 2 years that these people talked about would be the biggest rush of selling actually ended up being the 2 lowest years of new listings in history. Can you ever be so terrible? Yes, you can.
No,
you can do it.
We would welcome some of that inventory. We don't want to crash at all, but like, give us some of that Airbnb, give us some of that, silver tsunami stuff that's sitting out there. We would welcome it.
Yes, but in the concept, if most sellers are buyers, then all the inventory channel makes sense for decades, for many decades. But the one period in time it didn't was the housing bubble crash years. And I used to always point this out on Twitter where, listen, last 2 years, 30 to 90,000 new listings. 2008 to 2012 period was like 250. Weekly. Yeah, weekly, 250 to 400,000 per week. These are not people who want to sell their homes. They are forced to sell their homes. Not to mention that, 2005, 6, 7, and 8, we had 4 years of foreclosures increasing. Then the job loss recession happened. So there are a lot of things that we do have a period in time in history that we reference, that we model out, that we use in our data lines. And that was very credit driven. We don't have that now. So the whole prices falling volumes was 2023, 2024, and now kind of everybody's kind of throwing up the white flag. And even some of the biggest doomers in American history are kind of like trying to forecast something. Because I guess, listen, people, these are not serious people. Okay, just you have to realize this. I know they have millions of viewers and all that stuff, but listen, if you want the real show, the brain candy, the chart daddy, I have challenged these people to live debates. It did not end well for any of them. Okay, and I'm showing mercy too.
You are. I think you are. Okay, so you were too low last year. When you look at the forecast for this year, because one of the things that I remember talking about this time last year with you and with other people was like, it was surprising to some, like how firm prices stayed, even though rates got higher. And you just talked about that, but like looking into 2025, we don't think rate, you have your range for rates. What's your range for home prices?
So 1.77% nominal home price. I'm a back-to-back negative real home price year. Inventory is growing. Inventory should grow again. New listings data should get to the target levels that I have this year. And that is all a positive thing, because as every year goes by and price growth slows, right? No crashing, but slows, wages grow, households grow. And what happened is, I believe in the last few months, we're working from such low levels. It doesn't take much to move the needle. And we just got a little bit of movement. It grew sales. What we can prove now is that if mortgage rates just stayed at 6% for the whole, if it was between 5.7, I mean, this is hypothetically very difficult to happen, but 5.75 and 6.25, 500,000 plus more home sales total. Wow. Everyone's forecast would be wrong. It's just that getting to that level has been difficult, as we've talked about, right? Labor over inflation. And you can get growth in sales. And that's really the history. After the qualified mortgage rule, inventory channels changed. But in previous decades, you'd have rising inventory and rising sales and rising prices. That was very common. In the 80s and the 90s, even in 2000 to 2005, inventory was growing, with sales were growing. But now it's so many things have changed with the credit markets that I saw glimpses of it in 2024, which made me so happy. But going out in the future, we work with that supply and demand equilibrium. And also we have to remember that Texas and Florida are dealing with their own issues, also New Orleans. So much like what we saw with the 1 year that home prices fell nationally outside of 2007-11 was 1990, 1%. A lot of that was Southern California driven. So you can make a case Florida, Texas, some other will kind of slow the average down even more. That's why my forecasts are lower than everyone else's. I'm kind of going with historical models here that whenever you have a big period of price growth, things just slow down. And I know nobody likes negative real home price discussions. Like, they don't understand it and stuff. And people look at me like I have 7 heads on my shoulders. But having negative real home prices after a price growth period like we had is pretty normal. So that's why my forecasts are a little bit lower than everyone else's.
And still, at the end of the day, it's growth. I mean, it's not like you're saying home prices are going to fall, 10%. I mean, you're saying they're going to slow down to growing 1.3, whatever.
It's growing. And then, of course, when you have negative real home price growth and wages grow, household formation grows, affordability technically gets better to a degree. So I just think consumers don't like real home prices. Doesn't make sense to them. I remember speaking in Orange County in 2019. I had this big old chart and I was like, we have negative real home prices. That's excellent news. And everybody's looking at me like, what are you talking about? I was like, it is. And I was like, this is not working. So.
Well, I'm glad we have you. So let's talk about purchase apps. What have we learned this week?
Yeah, purchase apps, positive week to week, positive year over year. Again, some of this is still the seasonal demand curve. What we have seen in the last few years is, there is some practical reality to the seasonality of the bond market. Bond markets typically have sell off kind of after February. What we've seen in the last few years is that purchase application data basically stops growing. Rates go up and that's it. It'll be interesting this year to see, because we saw some firmness in the data Does that change a little bit now going out in the future, continuing this? And of course, rates aren't at 8%. The spreads are better. But normally, just normally speaking, if we take the post-COVID data lines out of the way, usually the second week of January to the first week of May, total volumes always rise. Volumes rise, supply rises. Again, supply, volume rise. Most sellers are home buyers. People put their homes on a market. They're ready to sell their homes, buy another one. So we'll see if that changes. That's what I'm keeping an eye on. But the last 2 years, mortgage, especially last year, 6.75 to 7.5%. 14 negative prints, 2 flat prints, 2 positive prints. Not a lot of volume declines, but just not a lot of growth either. That forward-looking data line created a very negative curve for sales data. And even though we had a growth in the last 3 or 4 months in existing home sales, what occurred was that we still ended up the year just slightly down year over year. Still held that 4 million level, but back-to-back historically low levels of sales considering our workforce and our demographics. It's not like we have underwater mortgages. It's not like credit is getting tight. This is a straight affordability issue. But the construct of the housing market, because the credit data are so good, it kind of stayed intact. But the sale levels are just historically low. Better the last few months. I'm imagining that pending home sales data does get hit coming up in the next few days. Our weekly tracker has gotten softer the last few weeks, but just recently, purchase apps have gotten a little bit better the last 2 weeks.
I feel like that 4 million now, that's definitely like even in all the conditions of, rates over 7% and we have all this other stuff, it feels like that's the baseline of like that many people need to buy a home every year, no matter what, and they can afford to buy a home.
That's our token line since 1996. I remember in 2000 or 2020, probably there's been a lot of times where I get tomatoes and cabbages and stuff thrown at me, but one of the craziest things is I wrote demographics crush the housing bears, and I said, you know what, we're going to have positive home sales in 2020. Back then, people still couldn't believe the COVID-19 recovery was happening. But I said the forward-looking data are getting better, and that we're going to have positive sales. Everyone thought I was crazy. It ended up being 300,000 higher in 2020 than it was in 2019. So keep an eye on apps, but we could see now that 4 million level just holds, right? It doesn't crash. We could have, let's say, home sales end of year at 3.97 million, something like that, but you can see that there's just that core base home buyer, that home seller that's a buyer, that there are a lot of people that have a lot of nested equity. There's $38 trillion in nested equity to sell their house. For them, especially as they're older, their wages are much higher. And if you need $103,000 to $110,000 to buy a house in America, think about people in their 40s and 50s, right? Dual household incomes, easily $200,000. That's how you still have 5 million total home sales. Of course, the builders are doing much better than existing homes because they live in a sub 6% mortgage market. But if you could imagine a sub 6% mortgage market world, the Fed couldn't take it, Sarah. They couldn't take it. Too many people will be buying homes. Too many people will be having sex. Too many kids. They just go, no, all this is inflationary. It's bad.
I do think when you look forward at 2025 and especially 2026 too, like in the mortgage industry anyway, we've had just tons of layoffs. We've had a contraction in the number of people in the industry and in companies, lots of consolidation. So if you have this base of like this is how many transactions you're going to have, at least it's split among fewer people. Right. I mean, I would vote for booming sales. I wish we had this, incredible market, but at least it's like, I think there's less people around to share it.
My numbers can be off, but if I remember right, it's like there was like 485,000 loan officers.
That sounds right. Yep.
And then now it's down to 93,000.
We have heard those numbers. Yeah.
And out of 93,000, probably 42,000 of them do kind of volume work out there. So It is, again, when I say the biggest and fastest crash ever, we always have to remember that the workforce is a lot bigger now. So also the employment of the people in the industry was bigger. So the existing home sales had such a crash, but it's, again, transfer of commissions, right? That's why the Federal Reserve and economists don't look at the existing home sales market as like a big macroeconomic thing. It's commissions being traded. It's for the consumer, for the people, it's a really big deal, right? For moving trucks and local economies and everything on that side. But as a direct sector, the new home sales market and construction workers mean a little bit more to the Fed. That's why we say the 2025 wild card is the new home sales sector. But existing homes have had the lowest home sales ever. This is now the calendar 4 year going in. So again, but just like the 1980s, right? In the late 1970s, the baby boomers were playing the millennials. I always ask this question: was there avocado toast back in the late 70s? Like what were the baby boomers like eating that was not? I was 5, I don't remember. So what was it, Sarah? That was
Oh,
it, like,
I see. You're asking me because you think I remember, but I'm not a baby
Chef
boomer.
Boyardee?
Yeah, but that was so cheap. It was so cheap that wouldn't be the avocado toast.
So the baby boomers back then were couldn't afford Chef Boyardee, but they were buying homes, right? Because inflation was rampant back then. Okay, and
listen, when I was growing up, we had Hamburger Helper, and we were I would say my dad was an officer in the military, a solidly middle class family, and we ate Hamburger Helper on the regular. There were a lot of us.
little creepy, the Hamburger Helper marketing thing.
Yes.
Yeah,
And I mean, I'm one of 6, so I get it. Maybe that's why. But like, I just don't think I don't know what the avocado toast equivalent would be. But boomers out there, if you remember, if you're like, oh, I've got this answer, let us know. Okay, Logan at hwmedia.com and Sarah at hwmedia.
Yes. And what happened was they were buying homes. They were having sex, they were having kids, and home sales went from 2 million to 4 million. Mortgage rates went up to 18%, right? Oddly enough, still not a lot of people know, home prices grew faster from 1977 to 79 than from 2020 to 2022. But then home sales crashed, just like we see now. But affordability was worse then. Inventory was higher then. We had less workers, and there was a recession, and home prices didn't fall. But mortgage rates fell 2.5% plus. Demand vertical. I show these charts on the Nerd Tour, and I say, look at that vertical move with the worst affordability because rates fell. So that's why when I say that the fastest velocity, we actually do have a model for this, the worst affordability ever. Rates fell 2.5% plus, and sales vertically went up. Again, when you were such low levels, that first move is always going to be big. It's what happens after that. So we haven't had that because we haven't had sub 6% mortgage rates, but if you look at what the builders are doing, the builders are, hey, we're still up here in 2019 levels. How you guys doing? You guys don't have the sub 6% mortgage market. Okay, all right. So it's a shame because there becomes a sociology thing. How does a country handle not being able to sell and move and move their lives? And I'm hoping one day, Federal Reserve all looks in the mirror. They look at themselves. They're going, maybe it's a good thing to just be living, and we don't have to worry. Again, not 3, not 4, not 5, but just mortgage rates heading towards 6%.
Would be amazing. I did want to mention, of course, our Housing Economic Summit is coming up, and if you're watching on YouTube, you will see Logan's cat make an appearance right now. That is a giant cat.
He is a Maine Coon stray that is a very, very big baby and is a menace because he's so loud, even if I put him outside. So he
will cry so loud during the podcast sometimes.
It's like a banshee. He's like a banshee screaming. It's like worse than a child or something. So yeah. But
so I was going to say, for the Housing Economic Summit on February 26th, not only will you be speaking, not only will Mike Simonson be speaking, but we have a whole time set aside for wild cards. what's happening, because we know in between here and there, things are going to come up and we're like, listen, we need to set aside a time just for whatever crazy thing is going to happen between here and there that's going to affect things. So I would tell people what they need to come.
And also, it is a very critical time in our tracker data, January, February, and March, really to get a good idea of what's going. So far, what we've seen in the new listings data is just pretty traditional. We're trying to see if we could just get back to normal on the new listings. I believe we can just get over 80,000 in the peak seasonal months. So, but again, so far, the first few weeks of the year, it looks normal on that front. But I'm hoping that we get back to normal new listings. And again, most sellers are home buyers. Inventory growing is a positive. It shouldn't be looked at as a negative.
Well, I appreciate it, Logan. Everybody check out the tracker. It is now live by the time this comes out, and we will talk to you again soon.
Pleasure. And eat your avocado toast and your Chef Boyardee. But all I remember as a kid is spinach, right? Because Popeye the Sailor Man. Robin Williams played Popeye when I was a kid. God, that was a long time ago.
Okay, see, you're old too. I'm just saying. I'm not that much older than you. All right. We will on that great note, we'll talk to you later.